as we move into the new calendar year, information is going to start flying thick and fast. From a top-down perspective, one item to note will be the release of the so-called Beige Book in America on Wednesday the 13th of January. More formally known as the Summary of Commentary on Current Economic Conditions, this document is published 8 times a year by the US Federal Reserve, and it features anecdotal evidence on the American economy across the 12 Federal Reserve Bank districts. It can influence monetary policy, and the next meeting of the Fed to discuss interest rates will conclude with a decision on the 27th of January, so that is a date for the diary. Investors might also like to keep an eye open for 2 other datasets which are due for release in the USA this week. They are the latest weekly unemployment claims data on Thursday the 14th of January, and the Job Opening and Labour Turnover Survey, or the JOLTS, on Friday the 15th. The weekly unemployment claims figure peaked at 6.9 million in late March as the pandemic hit America and lockdowns were imposed. Thankfully, it's come down a long way since then, but the number of new claims does seem to have stopped improving, and the December 26th figure of 787,000 new claims is your benchmark here. The JOLTS survey helps to measure job vacancies. As you might expect, the more vacancies an economy is creating, the stronger it's likely to be, although the opposite also applies. The number of vacancies plunged to just 266,000 by last May, only to rally a little bit to 336,000 by October. It'll be interesting to see what November brought, especially as the pandemic began to really make its presence felt again in the States that month. On the home front, we've got a busy week, as retailers in particular will be updating shareholders with comments on Christmas trading, although watch out for a few house builders and big recruitment agencies too. Names which may be worthy of further research include the following, although please do note that these dates can be subject to change. Abcam on Monday the 11th of January, JD Sports, THG, Games Workshop, DFS, Vistry and Robert Walters on the 12th, ASOS, Sainsbury, JustEatTakeaway.com, Persimmon and Page Group on the 13th, and Primark owner Associated British Foods, Boohoo, Dunelm and Halfords are the retail names in the frame on the 14th, while other companies to note that day will be Hayes and Taylor Wimpey. But the company most likely to cause a fuss in the week ahead is Tesco. The grocery is scheduled to release its third-quarter sales figures and a Christmas trading update on Thursday the 14th of January. Given how heavily the UK has relied on its single biggest grocer in the past 12 months, thanks to the pandemic and the lockdowns, Tesco's market share is 27% according to consultants Kansar World Panel, you might be a little bit surprised to learn the shares are actually down by just under 10% over the past year, although this is still better than the FTSE 100 overall. This does, however, follow a similar pattern at rivals Morrison and Sainsbury for what I would guess are fairly similar reasons. First, Tesco's lost a little bit of market share over the past year, albeit only 0.3 of a percentage point, in what remains a fiercely competitive market. Second, that market could be about to get fiercer still. Marks & Spencer is cementing its relationship with Ocado, Morrison's is working more closely with Amazon, Aldi starting to offer click and collect and delivery services, and Amazon is preparing to offer delivery services to its Prime Service customers. And finally, the pandemic means that volumes and sales have gone up, but so have COVID-related costs, by some £725 million at Tesco's last count, so the overall benefit to profits could turn out to be fairly limited. In addition, Tesco stated back in December that it would repay £585 million worth of business rates relief to Her Majesty's government. Tesco doesn't normally publish profit or cash flow figures alongside its Christmas update, so attention will really focus on the like-for-like sales growth figures for the third quarter and the festive period. At the first half stage, like-for-like sales growth was 6.8% across the company as a whole, 8.5% in the UK and Ireland, while sales fell 1.5% at the Eastern European operations and by nearly a third at Tesco Bank. Analysts will then look beyond those headlines for more granular detail that Chief Executive Ken Murphy feels able to give. Remember that at the first half stage there were some big shifts in business mix. Within retail, online sales were up 69%, convenience store sales by nearly 8%, and large format stores, their revenues were up by just 1.4% like-for-like. Food sales were up by 9% while everything else was down, while at wholesaler Booker, retail sales were up 23% and catering sales down 41%. Above and beyond such nitty-gritty, analysts and investors will look for an update on the sale of the Thai, Malaysian and Polish operations. The Asian disposal received local regulatory approval in December, They cleared the way for a £5 billion 51p a share special dividend payment to shareholders, providing they give their consent to the specially convened meeting, which is due in spring. The Polish deal is due to close in spring and could yield around £300 million in cash all in. Both Asia and Poland will be treated as discontinued segments in these results. Finally, analysts will be watching for any change to management's profit guidance for the fiscal year that ends in February 2021. The last published consensus for stated pre-tax profit was just under £1.4 billion, a small improvement on the prior year, although that was dated November on the company's website, and Tesco has agreed to repay the business rates relief since then. I hope that you and your families are all in good health and good spirits during these difficult times. Happy New Year to you. Thank you for listening, and I look forward to talking to you again next week.